Hi, this is Hyperwave. Tyler just went off for a quick coffee, so you're stuck with me for a tiny bit. Yes, I have a new apartment. So today we are going to talk about the stock markets because everybody has been freaking out. It is looking very interesting. Also, Bitcoin is not doing all that much, and I'm sure you guys heard us talk about Tether on Monday. But yeah, stock markets internationally, it's painting quite an interesting picture. Also, you will see me pulling up the trading view charts, which everybody here knows I am quite terrible about. I hope Tone's not watching because he tried to teach me it, but one of these days I'll figure it out. Yeah. So Ty's still grabbing coffee, so you are still stuck with me. I did a little bit of a tweet storm about Uber this morning because a lot of very interesting things are going on, and it's a lot that you guys can investigate in the meantime, but I think potentially very worrisome even for the US stock market. So they're issuing a lot of junk bonds, a bunch of companies, right? Uber, Lyft, our favorite competitors, are going at it, trying to do an IPO as soon as possible, but issuing junk bonds. And the thing is that's pretty strange is that BlackRock actually and Fidelity have already been their biggest shareholders. So who's going to buy? Why? Right? My hypothesis, to be honest, is that they're trying to push them to cash out, that executives are mad at them. I mean, there's a lot going on, but what does it mean for the stock markets? Does it mean that they're worried? Does it mean that they think that they need to get in now, that they need to get in for what's going on? I mean, typically you do an IPO for, a cash infusion, but Uber pretty much acts like a publicly traded company, yet they're private. But what does that mean, right? Also, like, oh, Tyler's back, so I get to throw him back on. I'll just say the Russell's looking weird. All markets are looking weird. All of them are concerning. MSCI, I don't know if you were following Tyler, but they're adding Saudi Arabian index. And I'd love to hear you talk, which we are going to be talking about mutual funds in our latest webinar, which we will discuss in a second. But China is looking extra bad. You guys know that's my favorite market to cover, especially the Japanese markets, because that's my background. And as I tweeted, they're now looking at $1 trillion of debt in China. So people pull up the CSI, figure out what that is. You'll have fun with it in China. And with that said, Maestro, let's talk about the U.S. stock markets.
Great. Thank you very much for covering for me as I get some early morning coffee. I've been up since about 4 a.m. our time, and just thinking about and looking at charts on the U.S. stock market, I am very disappointed in the action over the last week. We had a very big day and no follow through at all, which is not a very good sign. What we're going to do today is we're going to take a look at a number of charts together right through Friday's close, yesterday's close, because that's the weekly close. So we've got weekly charts on various parts of the U.S. stock market. And then we will pull up a number of charts just live one at a time, because there's several industries and sectors that are leading the way down, and several industries and sectors that are doing very well. And in short, what's happening is there's a big shift between growth and value, in between aggressive types of technology, biotech, home builders, and more conservative stocks that have not done particularly well on a relative basis. They are taking over leadership, and it's very pronounced, and it's very troubling because it flies in the face of what the market has been telling us for the last 10 years. And on 3 different occasions this year, as you all know, that I had started raising some cash for our clients in increments, starting with about 15% out of the small cap and the Russell. And I thought that's all I would have to do. That's all I had to do back in February of this year. And then the market reestablished itself. And then again, in April of this year, we had to raise cash again, and then we had to put it back into the market. But in both cases, it was only about 15% and just coming out of the more aggressive areas of the market. And that's what Consensio told us to do. And then the market reestablished itself. And now we've raised that same 15%, but I am going to be raising more cash because Consensio demands that we raise more cash. And that's what I've been looking at this morning: where, how, and why, and how much. So those of you that joined us on our Consensio broadcast, we sort of ran out of time in terms of being able to describe in great detail what sort of cash to raise at various points in the Consensio signals from an uptrend to a downtrend. So we're going to try to go chart by chart through that this morning and help you answer that for yourself. Now, there are no rules. It's just what you are comfortable with. I will tell you what I am comfortable with at this point, but this is an important call this morning, an important vlog, because I am being forced to shift my view of what's about to happen in the stock market. I have not shifted that view, but there are some forces at work here, both politically and internationally, that are causing a lot of confusion for investors. And those cross currents are taking their toll on some of the US indexes specifically. One of the most important elements, I believe, at this point is the election coming up in a little less than 3 weeks. It's the midterm election in the United States, and in a sense, all of the chips are on the table. Both parties have gone all in a game of poker that the winner of this next hand coming up is going to determine one of two outcomes in my mind for the next couple of years. And I'm going to try not to make this a political statement. I'm going to try to be as factual as I can, but I want everyone to understand how important this midterm election is going to be on economic growth in the United States, corporate profits, unemployment rates, personal income and wages, taxes, which all add up. Those 6 things I just mentioned all add up to confidence in the stock market. And confidence of the stock market has been very strong for the last 2 years after the Trump presidency, in anticipation that those things that I just mentioned, GDP growth, low inflation, higher wages, lower taxes, higher corporate profits, and higher consumer and business confidence would follow after the election. That was the assumption the stock market made when it began moving up sharply, even before Trump had taken office. Now, that was a big bet on the part of the market that some of the things that Trump had said he would do would actually be accomplished. So that was an article of faith on the part of the US investors and world investors buying US stocks. But one by one, things began to happen in his first year and here in his second year. Those things that happened were that regulations were actually being cut across the board that affect business directly. Number two, taxes for corporations and individuals were achieved in terms of lower rates. Number three, consumer confidence began to build even though personal income and wages were not growing. But the GDP numbers began to pick up and inflation did not begin to pick up. That was all last year. But then GDP growth began to accelerate. Business profits began to accelerate. People that wondered if they would really see more money in their paychecks were rewarded because they did see that. And the stock market was rewarded for its faith in this shift in the way Washington does business relative to the business community and individual investors. And it was based on that I believe all of the indexes continued to move higher until earlier this year. I'm not going to go into all the politics of what's been going on. Everybody can make their own minds about that. But what I am saying is that because this administration has had free reign with Congress and more so with the judiciary, things that wouldn't have been passed have been passed. Which brings us to the midterm elections. If the Democrats take control of the House, then we no longer have that free runway, or Trump and the Trump administration doesn't, to get things done, which will cause gridlock, which very often is the best thing for the stock market. Because gridlock in Washington means things don't get done, so the rascals don't screw up everything. When things can't get passed, then you have status quo, and businesses can plan if they know that nothing is going to change. It's been different for the last 2 years, because in this case, when things were done, it was specifically for the benefit of the economy, corporations, and employees. So this time, if we have gridlock, I think it will be a net negative, and I think the market is beginning to sniff that out. Nobody knows what's going to happen 3 weeks from now, and the polls you cannot trust. We saw that 2 years ago. It doesn't matter how many polls tell you what's going to happen. You cannot believe them. They are not trustworthy. For whatever reason, we don't need to get into that. So we are left in a void from where we were 2 or 3 weeks ago after the Kavanaugh debacle that got everybody up into everybody else's face and started this acrimony that, regardless of how that came out, has gotten both sides ready to push the nuclear button on the other side. And it's all out war. And if you can watch any of these news shows or media events or all of the advertisements, I've never seen anything so despicable in my life. No one is being reasonable. It's all out war. people spitting on each other, shouting at each other, screaming at each other, not allowing people to speak. It's totally broken down. Well, as an investor with a lot of confidence in what had been going on for a couple of years, all of a sudden you begin to question, how bad can this get? Particularly if, as soon as the House shifts from Republican to Democrat, impeachment will begin very quickly, which will not, in my opinion, amount to anything except to tie everyone in knots for the next 2 years and assure that nothing gets done. And if anything is attempted to be done by the administration and the Senate, it will not get through the House. So that's what's on the line. Now, that might have sounded like a political statement. I'm trying to keep it from that. I'm trying to be as even-handed as possible about what I believe investors are thinking, what investors are worried about, because I'll tell you what they are not worried about. They are not worried about corporate profits. They are not worried about economic growth. They are not worried about consumer or business confidence. And therefore, why is the stock market doing what it is doing? It must be something external to economics and investing and stock portfolios. Now, we can throw in other things such as trade. And if this had been going on a year ago or 6 months ago, this being what we're about to look at in the stock market, I would say that a lot of the consternation has to do with trade policy and the US policy taking on global enterprises, such as the global warming, the Paris Treaty, such as the Pacific Trade Agreement, such as NAFTA, such as NATO. This administration has been turning upside down all of the relationships that had been built since World War II, one by one. We can argue if that's good or if that's not good, but it isn't something that is now occurring. This has been occurring. And if I take each one of those things, I can argue that it's getting better and better from the world's perspective, not worse and worse. Not from the left's perspective in the United States, but from the world's perspective. Let's just take a look at trade with South Korea, with Mexico, with Canada, and I believe soon to be announced with a number of European countries on a one-to-one basis, including the UK. In other words, what we were all worried about has not come about, just the opposite has come about. Trade agreements have been signed on a bilateral basis. The big one missing is China, and we know what's happening in China relative to their economy, which just reported a big drop relative to what everyone thought, relative to their stock market, relative to their debt, relative to their politics now. So at some point, we could very well see the US and China sitting down again, and you can either say that's happenstance or because of the policies. We're not arguing policies. I'm just trying to observe, why has the stock market in the last 2 or 3 weeks turned down the way it did in February and again in April, and in both cases it recovered from those 2 previous bouts, but it is not recovering now. And that's what we're now going to take a look at. because I think we are in a dangerous position, and it's not because of all the things that normally get us in a dangerous position. So I'm going to ask Leah to pull up charts. I'm going to run and grab a coffee, and I'll be right back.
Tyler, put me on the spot here again. So if you guys want to send in any other questions, I think that this is going to be a fun one. Definitely. Oh, I see that coffee mug. Hey, Ty. All right, let's pull this up. Guys, I know you love making fun of me with my terrible trading view, but, you know.
But I assure you I'm worse. So,
so go easy. It's also early. All right, guys.
We're going to go through the indexes one by one, and we're going to talk about them in terms of, could you make that a weekly, or is that the weekly?
It was daily. You're correct. Now it's weekly.
Okay, great. Let's just shorten it up to 2018 now.
Mm-hmm.
Perfect. That's going to be great. Okay, so what we're going to do is we're going to look at various ways of looking at the U.S. stock market since the beginning of this year. What we're really looking at here is we want to see let's see, something's wrong over on the far right side. We can't see the recent price action.
Might be slow. No, yeah, okay, no, it went back to weekly. Man,
There we
go. Drag it. Oh, look at that. Oh,
perfect. Okay, great. All right. So we're going to look at first 30 stocks, which is the Dow Jones Industrials, and then we're going to look at more and more stocks and bigger indexes. And what you see here are the three consensual lines, and you see the drop that we had earlier this year in February, and then the second drop that we had in June and July, and now the third drop that we're going through right now. That doesn't look too bad to me, mainly because the long-term moving average, the purple line there, and we're messing with your minds today because we're looking at is that a 3 or a 13 on the short moving average?
3.
Great. We're looking at a 3-period moving average and an 8-period average and a 40. And it doesn't matter why they're just minor adjustments. And you can pick your own moving averages. I talked about that in our Consensio webinar. But look at the far right of the chart, and you see that price is broken below the short term and the intermediate term, but is still above the long term. That would mean, basically for me, that I would be 15% in cash in this thing, whatever it was. And that's what I've done in my investment accounts. Is over the last 4 weeks, we've slowly raised 5%, 5%, 5%, and we've got about 15% in Dow type stocks in cash. The first one is when the short-term moving average broke through the intermediate term moving average, when the price broke through the intermediate term moving average, and when the intermediate term moving average turned down. Those three things are important as leading indicators that something bad might be starting. You never want to jump and say something bad is starting, nor do you want to ignore the evidence that you are looking at and saying, I'm just going to ignore this. Particularly if you've got retirement accounts where you don't have to worry about the taxes of making a move. If you're using no-load mutual funds to represent the Dow, for example, then getting in and getting out don't really matter unless you don't want to be taking big profits. But taking profits and paying taxes on those profits is far superior to holding on to something that's about to drop 10, 20, 30, 40, 50%, which we've seen twice during the last decade and a half. And that's what Consensio is designed to do, is make sure that doesn't happen. And everybody's got to make their own decisions how to use these three lines. I'm telling you how I do it and how I teach it, but the length of the moving averages, the periods of the moving averages, and the amount of cash to take out is really an individual thing depending on how aggressive or how conservative you are. Okay. Now, we have held during this past week, but made no progress, basically. And the week before, we penetrated down through the long-term moving average and then luckily popped back above it. So I can't say anything other than we've got lows above lows above lows, and we've got highs slightly above highs. And so this looks fairly healthy to me, but remembering what this index is, this is 30 stocks that include very few aggressive tech stocks. And that's important as we look at the other charts. So I started off with that one. Now let's take a look at, let's see what you have next. I think the S&P maybe.
Yep, let me switch to weekly. Also, live viewers, right now it's tough to see your questions. So afterwards, if you just tag, me in it, then I'll be able to go backwards. Also, I just suck at trading view. All right, hold on. We'll be getting it, Tyler.
No problem.
Or not. I like that you can go in the future. Oh, right.
Yeah, you can just pull that whole thing over from the, there you go.
Oh, man. I really suck at trading view. Okay, we're making movements here.
Okay, now this is the S&P 500. So this is 500 companies, which happen to include all the big tech, all the FANG stocks, but also all the Dow stocks. So the 30 we just looked at are in this, but you can see that it is not doing as well as the Dow is relative to these moving averages and to a couple of other indicators. So here on the big broad S&P 500 that many managers use and many big institutions use as a means of comparing what managers are doing relative to the market, we are now trading lower than the long-term moving average. Everything else is about the same. We went to higher highs 4 weeks ago than we did in the previous highs. We are higher in terms of these lows that are being established right now than the previous lows, which were higher than the previous lows. The long-term moving average is flattening out. It's a little hard to see on this chart, but you can't be turning down yet because price activity is not below it. So my assumption is it's just a visual problem with the moving average, and we're actually still moving up. Not quite at the rate we were before. And you can see this enormous down candle that we experienced last week. So on this one, I would be 25% in cash because we had the break of price below the intermediate term. We had the short term break through the intermediate term, and we had the intermediate term turn down. We are now flirting with price breaking the long-term moving average. That's why the extra 10% is thrown in there. So for me, a quarter of my position, whatever it is, X, that is related to the S&P would be in cash. Now, because 15% of the Dow would be in cash, and that 15% is actually in this, meaning the Dow stocks are in this index, the 25% to me would include the Dow, which is another reason this is 25%. If basically what you own are S&P 500 index ETFs, mutual funds, or individual stocks that look and act like the S&P 500, Consensio warrants a quarter of your portfolio being in cash and waiting to see what happens. That's those two things that down the S&P are the best of the story. Now we're going to get to the difficult part. So let's take a look at the NASDAQ 100. Even though it's fewer stocks, it is the problem area for this market, along with small cap. I suspect that something is wrong here. Can you just put your cursor on the last
refresher?
The last candle.
And then we also have the composite. So it's here's the NASDAQ 100 and the composite.
Yeah, I'm just looking at the date right now on the last candle.
Mm-hmm.
Yeah, that's the 15th. So this chart does not include through Friday, which is the problem I was having on mine. And so let's switch to the daily.
Daily?
Yeah, because the daily will pick up the most recent. And take a look at the last candle. It should be the 19th.
You want the
just the date of the last candle.
It's yesterday, so it's closing.
Okay, so that's great. So let's use this, and then we'll go back and we'll look at the other ones. Okay, so this is the S&P 500 on a daily, and let's make it a little bigger just by moving it to the left.
How far do you want it back, Ty?
What's that?
How far do you want it back? Right now it's to March.
March is fine. I'm more interested in what the damage is done on this daily chart using Consensio. And
I'm going closer here.
Right. Yeah. So we are sitting at 2767, and we got as low as 27. We'll call it 20. Now, if you just flip it back to the weekly one more time, 2720 is the low. So we have clearly broken down on a weekly closing basis below the long-term moving average. Maybe just put your cursor, down at the 2720 mark. 27, 70, 60, 40, 20. Okay, so that's where we closed the week. That's what I suspected. So we're going to have to fudge a little bit, but so we have closed below on the S&P 500, and that's why that 25% makes a lot of sense. When the intermediate and the short term cross below, if they ever do, that long-term moving average, we will be 100% out of this market. But we do it incrementally, and you can't guess of where things are going to be. One of the ways I try to get closer and closer to a decision on a weekly chart is by doing what we just did with the daily charts, which is as you're building towards the weekly close, you can start estimating what the range is during that week by watching the dailies and seeing what sort of damage will be done unless the market rallies or falls by the Friday close. All right, let's go back to the Dow, if you don't mind, Leah. And we'll do the same thing, knowing that the weekly does not show, that ends on the 15th. And we've got to add the other days. The 15th was that big up day. And so that is misleading. So now let's switch this to the daily. And this is actually what happened, is we had the big up day. And then following that big up day on Wednesday, we basically had a shooting star that kind of ran out of gas. And then we had a big down day. And then we had the final. But we are at 25,444, is that? 25,444 approximately. So now let's flip back to the weekly and see what damage was actually done on the weekly basis. 25,444. Now that shows the same 25,444. Why would that be? That's the 15th again. The 13th. Why is that missing? Sorry about this, folks, but someone needs to go to work at TradingView and make this stuff work a lot more easily. That's the weekly Dow Jones, and they're not showing the update. Okay, let's just go on to the next chart, the NASDAQ 100 again, knowing that we're not looking, yeah, is that the daily? Let's use the daily for the NASDAQ 100.
This is the NASDAQ composite.
Okay, could you do the NASDAQ 100? Great, which is the worst of all of them.
This is on the daily.
And what date does that show on the last candle? I'm sorry, I couldn't see it, Leah. I'm just wondering what the date is on the last candle.
Sure, it's yesterday. So close.
It's the 19th. Okay. 7107. Now, if you could just switch it back to the weekly. That just doesn't make any sense. How could it be the same number? It's not. It's 7128. Okay, so it closed a little bit lower than that. Okay. So the NASDAQ 100, according to this, still hasn't broken down other than the penetration.
People in the live chat are saying that at least within TradingView, the weekly starts on the Monday.
Right, Monday through Friday, right. But these are not ending on Friday. That one is ending on the 15th. So we are missing 2 days of data from Thursday and Friday. And that's what's so confusing about all this. So anyway, we get the general picture that all of these indexes we're looking at are coming right down, going below or slightly above the long-term moving average. And there's a reason for that, which has to do with which sectors are falling apart, basically. And we've all seen that home builders are very, very weak, but whole sectors have fallen well below their long-term moving averages and have closed below those. And maybe we can pull up a couple of those. If you just type in, they're all ARCA. So maybe just try typing in ARCA or.
Also Ty, at least, well, this is the info I'm getting, but the numbers is like, so the 15th quote unquote week is including 15 through 19. So they're saying the beginning of the week, if this is correct, but that is like the end of the week. Anyways, this makes no sense for me for the charting software I also use, but that is what I am hearing.
Well, that would make sense if they're saying, if the listeners are saying that the 15th that is showing up on the weekly charts is simply the starting date of the week, then that's fine. But it doesn't look right to me from the charts I've been looking at on TradingView all week long. But let's assume that that's correct. Then we can just proceed. So this is the NASDAQ 100. And according to that, it has not broken down below that long-term moving average, but it's penetrated it this week and the week before bouncing. So what we have, once again, is the short-term moving average going down, the intermediate term moving average going down, and the price now below both of those and still going down. Has not yet penetrated the big kahuna, which is the long-term moving average, which continues up. And because of that, that means cash should have been taken over the last 2, 3, 4 weeks as each one of those has occurred. This does not indicate anything more than about a 25% cash position in my mind for these big broad indexes. Let's take a look at the Russell 2000 if you've got that, Leah. This is the one that's been bugging me all week, because 7 weeks ago, it was leading the market up and had not done so for the previous couple of years. And that meant broadening out of participation in the marketplace, not just the aggressive technology and not just the growth stocks and not just the big averages, but all of a sudden the small and the mid cap were joining the party and going to new highs. But then look what happened. This is in a full-blown negative territory and indicates to me, although the intermediate term has not yet cut down through the long term, that it's going to be almost impossible to stop the intermediate term from breaking down below the long term. And that means you should be completely out of small cap stocks. 100%. This is not yet a bear market, but just projecting a day or two in the future, you can see what's going to happen. The short-term moving average has already cut through the long-term moving average, and that is going to pull that intermediate term down at almost the same angle that the short term is moving down, which will then turn the long term down. And by the end of next week, we will be in a full bear market in the Russell 2000, which are approximately 2,000 stocks, small companies between 500 million and $2 billion. But that doesn't matter. That means that if you have small cap stocks, you should be stepping aside and just waiting for further evidence that the large cap US stocks are holding. And we're going to talk about what could be happening and what might happen after we go through these charts. Now, what I'd like to do, and this will be a little tricky because you haven't built these yet, Leah, but if you could just pull up the RKH, which I believe will be regional banks.
All the tickers are always different in TradingView. And Tyler, you're muted. If you guys want to throw me what RKH is, maybe that's helpful. Which index is this? Ty, you're still muted, Ty. And maybe I'll know the ticker. Still muted, Ty. There you go. All right, Ty's coming back on. In the meantime, guys, while I have to fill Ty, which is not easy to go afterwards, if you guys haven't seen the video that Third Point came out with regarding Campbell, which they are a shareholder of, it is very funny and definitely shows it. Hey, Ty.
Is that any better?
Yeah, tough audio, but yeah.
Okay, regional banks.
Oh, that's what you were saying. Okay. I'm pretty sure the ticker actually for that is, well, I mean, it's always different on TradingView.
Well, if you just type in regional banks, it should come up.
All right, let's try it. And I spelled that wrong. I'm supposed to be a writer.
Okay, there is.
What would you like?
Let's do the S. Let's do. Jeez. Where's the ARCA regional banks? Or the S&P? There's S&P 15. No, that's not it. Incredible.
You have the Dow Select Index.
Type in ARCA, A-R-C-A, please. Okay, now we go down. There's biotech. Gold miners. Okay, let's try one more. SPDR.
Let's do it.
There they are. Okay, let's first go to the good ones. Utilities, XLU.
One sec, I can't see anything with my glasses.
Down 3 or 4 more. Down 5. There. Yeah.
You want weekly?
Yep, that's perfect.
Perfect.
Okay. There's a completely different story, which is what I was talking about before. Strength relative not only to what the markets are doing, but a fairly important part of the U.S. economy. And it is nowhere, you should be 100% in this. If you've got utilities, you shouldn't be worried about any cash. Okay, let's take a look at, let's just use the spiders for now. So just do SPDR again, and we'll pull up materials. If you see that, there's financials, there's materials. Great, XLB. Full bear market in the material sector. All three moving averages moving down, price below it. You should have zero money in the materials. They are in a bear market. Now, if you get enough of these in a bull market, like the utilities, or enough of these in the bear market, like the materials, that will determine the overall movement of the indexes. But we've already seen that the big indexes are flirting with danger, and we should have 25% of your money in cash in those. So now we're going to try to find out where the problem areas are. So let's go back to the spiders again, SPDR, and let's take a look at energy. I believe it's, I'm not even going to guess on what they're using for their tickers. There we go. XLEs, of course. Okay, XLEs, very important that we have dropped the price below the long-term moving average. Now that came very quickly, as you see, because just 2 weeks ago, we were close to the highs from back in May, and then just like that, they collapsed. Now, a lot of that's politics, a lot of it is Saudi Arabia, a lot of that is Iran, a lot of that is Venezuela. It doesn't matter what a lot of it is. Don't tell me what to buy, tell me when to buy it. And right now, energy, which was looking like it was going to help the market in general, is not in a full bear market, but it's getting there very, very quickly, and you should be lightening up on your positions fairly rapidly in the energy sector. Okay, let's go back to the spiders. And let's look at the financials. XLF. Surprise, surprise, the same thing going on there, and the long-term moving average is just rolled over because of the past 3 weeks. The intermediate has now cut below the long-term moving average, and the price is below all three. We have just entered a bear market again. Now notice, if you go back with your pointer to late June, early July, and you see the crossover of all the moving averages, go back 3 weeks, right there. Nope, right there, and go up with your pointer. Right there, see all the moving averages crossing over? Same as what we just saw this week, but the difference is the long-term moving average was moving up. Now, because we flattened out for the last 2.5, 3 months, that moving average flattened out, so that this action becomes very important, because the price breaking down quickly got through all the moving averages and it's turning them all down. Very negative for the overall stock market to have the financials begin to sputter. Well, what are the reasons? We can talk about this spike in interest rates on the 10-year from 3% to 3.28. We can talk about the war between Trump and the Federal Reserve. Again, what it is not of importance. Your money is not in the ideas behind the movement, it's in the movement itself. Don't tell me what to buy, tell me when to buy it. I was premature in thinking that this market was going to be able to overlook all this nonsense going on down in Washington. What the charts are now telling me as of this week is that danger is looming piece by piece. Okay, let's take a look at, hopefully we can find something that's positive. Let's take a look at the pharmaceuticals or the healthcare under the spiders. And spiders aren't the only way to look at it. You can look at, a lot of different ways, and you should be doing that. We just don't have time. I tried to build these this morning and my computer started to smoke. Okay, so spider health care. Okay, spider healthcare. Surprising because, yeah, can you remove the, there you go. Okay, up. Can you remove there you go. All right. This is not good, folks, because
financials.
No, yeah, healthcare.
You want?
Yeah, that's it.
Done.
Okay. Wow. That was a surprise. Okay. So looking good. That didn't make a whole lot of sense. All we've done is prices below the short and intermediate term, and the short has gone below the intermediate term. You could take a little bit off the table. This is either a 5 or a 10%er in terms of cash, but it is actually doing very well relative to those tech kind of stocks, the material stocks, the home building stocks. And it is actually, because it's so far above the long-term moving average, looking reasonable. So no reason, maybe take, a little bit off if you haven't already covered it by taking it out of S&P or Dow. Everybody's portfolio is different. You've got to understand what you own when you do this kind of analysis. If you only own indexes, either through mutual funds or ETFs, then it's easy. All you've got to do is look at the indexes. But if you've got indexes that are inclusive of other things you own, like sectors and industries, you've got to tailor this analysis, consensio, to each part of your portfolio. If 90% of your portfolio is in a Vanguard Star or the S&P 500 index in some way, then what happens with the other 10% doesn't matter. Your money's tied up in the S&P 500. Therefore, use that as your main driver. If you've only got 20% in indexes, and then you've got a whole bunch of sectors and 1 or 2 or 3 stocks that are making up a large part of your portfolio, you've got to use this on each of those individual things, each individual stock, each individual industry, each individual sector, as well as the indexes. Okay, let's just do one other, because someone mentioned how poorly it started, which was the retail, and that is not under Spider. It might be under RTH, but probably not. RTH is the old symbol for retail. Let's use that. Great. Van Eck. Thank you, Van Eck. Van Eck is the same one that wants to come out with the Bitcoin ETFs, and would probably do a very good job if they did it. They've been in the precious metals market for 50 years and understand how to build those kind of things. Okay, here's the retail ETF, and not looking horrible, at least this particular grouping of stocks within the retail sector. This is a 10 or a 15% cash kind of a position. Okay, so that's the way I look at these things, and how I analyze them and how I make decisions where and when and how to raise cash. And we didn't have time to do that on the webinar, and I apologize for that. We are going to be doing another webinar here on October the 3rd, because mainly, and I want to talk about this just for a minute, the election is 3 days later. So we're going to do a webinar on Saturday, October the 3rd, 3 days before the Tuesday midterm. We've just looked at a whole bunch of charts. I've said I need to raise some more cash for my fiduciary clients. We've been sitting around 15%. I'm going to take that up in the early part of next week, depending on what happens. I'm hoping that the relative strength we saw on Friday will continue on Monday and Tuesday. But I'm going to be looking at the daily consensio, the weekly consensio, the monthly consensio in each of the areas that we just looked at to make my decision what I'm going to do. And that also means for our consulting clients, I'm going to be specifically telling you portfolio by portfolio how and what I would be doing. But for those that are simply listening into what we're talking about, if you have not listened to the Consensio webinar, we will have another one coming up that will not be talking specifically about Consensio, but it will be talking about the stock market in the election. And it's going to be about GBTC specifically, but more generally about closed-end mutual funds, and more specifically about ETFs, and more specifically about mutual funds, how all of those have different characteristics that can be used in markets like these, meaning markets that have been trending for 10 years and now are giving signals that maybe this is different than what we saw in June and what was different back in February and March. This could be worse. That doesn't mean we're going into a bear market. Nobody knows that. What it does mean is you should be raising cash in anticipation, according to Consensio, that is a possibility, and you don't want to wait for the evidence to come in that is occurring, being fully invested. That's what Consensio does. It's an agreement on the reality of fundamentals, the reality of technicals, and specifically the short, intermediate, and long-term reality of price relative to trend. Okay. We will be getting information out about that webinar. We are reducing the price from $150 to $100, which means for our consulting clients, it'll be $50, and it will be $100 for everyone who is not a consulting client, except for our Hyperwave research group, many of which are also consulting clients, but those that aren't, just as a way of thanking you for all the help that you've been giving us. We will be doing a lot of analysis on Hyperwave as we get towards the end of the year, and we're going to make that public in Las Vegas during the conference. Leah and I will be teaching a very long class, many hours, on how, when, why, where Hyperwave works, with many examples of current Hyperwaves. That'll be the first time in public that we've talked about that since about 20 some odd years ago, where I did it briefly in front of 3,000 people down in New Orleans. But because of our research group and the work that we've been doing and the information we've been giving on our vlogs, we're going to be able to go into much, much more detail on why it all works. in January at the Unconfiscatable conference that Tone Vays has put together. It is going to be one heck of a wonderful, fun time. If you play poker, if you don't play poker, if you want to meet all these maximalists that you either agree with or disagree with, but you're going to be able to stand around for 4 days, sit across a table from them, ask them questions, listen to them give talks in great depth about what they know. Giacomo and Jimmy Song and Peter Todd and now Max Kaiser, and it's going to be terrific. It's going to be a wonderful time. And I'm just saying that because Leah and I are going to hold off getting into Hyperwave in great detail until that. We want to make it a special opportunity for people that have come a long way to come to the conference. So that's where we're going to talk about that. The one coming up, though, in October, I think you're going to find fascinating because of what I'm about to say, which many of you may or may not agree with. But I still go back to, I think this is a political climate that is causing this disruption in our stock markets. I'm hoping that. I hope it's not more than that. It could be, but the economics, the business climate does not indicate that we should be anywhere near a bear market. I do not buy that there's any problem with an inverted yield curve. When a yield curve inverts, which this one has not done, you've got another 18 months before it begins affecting the economy. And we have not even seen that yet. We've got growth in GDP. We've got growth in corporate profits. I believe that what we're seeing in the stock market is political confusion for the reasons I outlined before. Now, I'm going to give you a couple of statistics that I mentioned for those of you that happen to hear the Consensio webinar. So I'm repeating myself, but two very important statistics about stock market movement is that the two worst months of the year tend to be September and October. We made it through September with a little damage beginning. We've almost made it through October with only 11 days left with more destruction. And that's the only way you can describe what we just looked at in terms of the Russell 2000, in terms of home builders. We did not pull that up, but take a look at that chart if you haven't seen it on CNBC. It's frightening. And a number of sectors that, like the materials that have broken down, that's destruction. That is not good action. You should not be in those things. But that does not square with what I've just said about the stock market and the economy. Therefore, something else is at work. Okay, September and October might be at work. That might be just part of the historical norm that these tend to be nasty months. But then, concomitant with that observation is the best 2 months of the year tend to be November and December. You almost always get end of the year stock market rallies. Not always, but statistically, they are very good months compared to any of the other months and compared to any duo month like September and October. Therefore, we should be 10 or 11 days away from the beginning of a strong close to the year in the stock market. More importantly is the politics in terms of the midterm elections. And I've checked this on 3 different occasions with 2 or 3 different sources, and I believe it to be true. Maybe somebody can find something that contradicts what I'm about to say, but there have been 18 midterm elections since World War II. And it does not matter who is in office, Republicans or Democrats, or someday maybe an independent. It does not matter if during the midterm elections there's a violent shift from one party to the other in either or both the House or the Senate. Does not matter. In all 18 of the 18 midterm elections, the following year is positive, without exception. Does not matter about the politics, which to me is fascinating. Now, some years are better than others, and some are actually fairly flat, but no negative years, 18 times in a row. And why are there only 18? Because we're talking about midterm elections, not presidential elections. That means they occur every 4 years. So we're talking about 72 years approximately since World War II. Therefore, you've got 18 of these things occurring. But that's a remarkable record. So here's what I believe. I believe that we've got a lot of confusion politically. We know that everybody is at everybody else's throats, and there's no gray area in between. You're either the devil or you are the angel, and depending on which side of the fence you are, it's the other side that's the devil and you are the angel. And therefore, it's become almost a spiritual war, which is idiotic, but that's where we are. We've got, people's inflamed faces running onto elevators, spitting on other human beings, screaming in their ears. This is insanity, folks. And when insanity takes place, what happens is things like our day-to-day lives shift. And that means confusion in things like the stock market and in our own emotions. And we turn the television off instead of listening to things. We become disenfranchised. All right, that's all going to end in 3 weeks. The bitterness is not going to end, but the result of that bitterness is going to come to an end. Donald Trump will still be the president, will be for the next 2 years, regardless of the outcome. He is not going to be impeached and removed from office. The attempt might be made, but not if the Republicans hold the House. So this is a binary election. We are either going to continue the economic policies, forget about all the others. I'm just talking economics, finance, and the stock market. We are either going to end all of the momentum of those policies in 3 weeks, or we will continue it. I believe we will continue it if the Republicans hold the House. I will guess that the Republicans are going to lose a number of seats in the House, but I will also guess they will not lose enough to lose the House. I will also guess that the Republicans are going to actually gain net seats in the Senate. Not a lot, but maybe 1 or 2, maybe as many as 3, regardless of what happens on the House side. For the stock market, and this is a big, big stretch, folks. I know I'm way out on a limb, and it's a long way to the ground. But I believe that what we have been seeing for the last 4 weeks or so in the stock market is almost 100% politically motivated. It is happening because of the confusion that I've been describing. And I think that will be resolved in a positive way if the Republicans don't lose the House. I think it will be resolved in a negative way if the Republicans do lose the House. Now, if the Republicans lose the House, does that mean the stock market's going to go down? No, I don't believe that for a minute. Because the momentum of what is in place will continue for the next couple of years, economically speaking. Interest rates are not going to go up abnormally fast. GDP is not going to drop. corporate profits are not going to go down. It simply means that the momentum will be broken in that no new policies supporting that economic growth are going to be able to come out over the next couple of years. Therefore, I think we will be living in a different stock market world, which might not mean prices going higher and higher at ever accelerating rates. And that is a possibility if the Republicans don't lose the House. I could see a 40% return between the beginning of November and the end of 2019 going into the elections, if everything stays the way it was prior to the midterm elections. And I could see a flattening of economic activity and the stock market between now and the end of 2019 if that does not occur. So that's the first time you've heard me talk about the political impacts on the stock market, but I have no other explanation of why we see things breaking down other than that one. I would love to get feedback from everybody about other alternatives other than what I am now describing, mainly so I can think about it. One of the reasons I've been up late a lot is because of just pondering what the heck could be going on. And that's the best I can come up with. And with that, I will shut up and turn it over to Leah and see if Leah wants to join in this tirade.
I think because the English Premier League is on right now, that everybody should get off their butts, stop listening to us. Wow, I like orange in this lighting. I like it. And hope that everybody enjoys. Thanks for dealing with me with my attempts with TradingView. I know that I'm bad, guys, but I will be getting better. Absolutely, the webinar coming up, as Tyler said, we'll talk about it more, but it's going to be really, really fun. Any feedback that you guys have on the Consensio webinar, absolutely let me know. And yes, you can continue to watch it actually for the next until midnight on Wednesday, so you have a good amount of time. And with that said, have an amazing day. Tight.
Great. Thank you all.